I think it behooves the startup to really think carefully about the long term and not just go after this immediate cash. The math of venture capital is really unique because we as investors go into investing and building a portfolio knowing that many, if not most of our investments will actually fail and go to zero. The reason an investor wants to be in venture capital over less risky, more traditional assets is because historically it has outperformed other asset classes. And so the way we get there is by having enough companies out of a large portfolio do so well that it makes up for any of the losses. If we have more money going into these startups, and maybe the government can have a role in providing non-dilutive grant funding as part of this. Some countries are very good at this, some countries do less of this. That can help stimulate the economic growth as well.
For those that are joining us right now, because we're filming, we are here in UPC University. We are having a talk with Ron Levin. He is he's managing partner at Alumni Ventures. You're based out of Boston. You've been entrepreneur in the past with Travel Perk. You led B2B in Booking.com. And here today we're going to talk about the venture playbook. We put that name because that gives us a lot of room to explore, because we can talk about how to work with corporates, but also, we have so many entrepreneurs here, so they might want to pick your brain on being a better entrepreneur. And before we start, I want to give a big shout out and thanks to BCP, who made this event possible, thanks to BCP Partnerships. So if you don't know BCP Partnerships yet, you should reach out to them because they're going to help you work with BCP Bank. So let's start and let's talk about this partnership. What are the key ingredients or chemistry that there should be when we want to have a successful startup and corporate partnership? What are your thoughts?
Sure. Well, there's clearly a lot of different ways that startups and corporates can partner with one another. Certainly there's commercial relationships. One sells to another and so forth. There's distribution relationships, partnering to distribute a synergistic product. And there's more strategic partnerships as well. Investments, a large company investing in a smaller one because they want to keep an eye on things and maybe, as we would say in the business, take a flyer. Like a corporate might say, hey, this seems interesting. It might become something. We want to be a shareholder now, and then see how things develop. But these kinds of partnerships can also take a lot of time, and it requires a lot of mutual buy-in, right? For a large company, it's a risk to partner with a startup. They're putting a lot of faith into some entrepreneurs who might have some ideas, but it's still largely unproven, how the product works, will it sell or not. And for the startup, they tend to invest a lot of time in developing these big customers because they want to show that they can play with the big guys, right? That they can, sell to big customers, that they can partner with big customers. And so it can eat up a lot of their time. And if things don't go well, then they will have spent a lot of their capital, both human capital and financial capital, on something that might not work out. So there's risk on both sides. So I think it's very important that when corporates get together with startups, they need to have very transparent relationships. They need to be able to talk about the good, the bad, the ugly that's going on, what the risks are, be very open with one another. And I think it's important that corporations that want to be involved in working with startups really think about how they're going to do that. Does it mean that they're willing to be customers? Does it mean that they're willing to partner for strategic distribution? Does it mean more? Does it mean, hey, we're going to have a corporate venture capital arm that's specifically going to invest in companies that we think we might want to be involved with or potentially acquire at a future date? Or are we going to have our own accelerator program, as many corporations do, so that we can help incubate some of these companies and use our resources to get them to a later stage of development and de-risk some of it. So a lot of different ways to partner, but I think the transparency is really key early on so that there's a mutual understanding of the expectations of either side and the willingness to accept some level of risk, because there is a lot of risk on both sides as startups and corporates form these early relationships.
Awesome. Just to see a little bit of understand the crowd, So how many of you have done some sort of partnership with a corporation? None. 2, 3. Okay, they're kind of shy. You know, they don't want to show up. But it's perfect that you've tried. From those that have raised a hand, how many have been successful at doing a partnership with a corporate? Okay, okay, so half of them. It's a good number still. Um, so you've mentioned a bit also the whys of why. You know, it can help boost sales. It can boost your reputation. But when is it a good time not to partner up with a corporate?
Yeah, I think that it's really when you're still exploring. I think some startups can get caught in this, hey, we have some interest from a large, well-known brand. We're developing a product, and they seem interested in investing in us or buying the product, but it's going to require a lot of work. They need to do a lot of due diligence. They need to make sure it's legally compliant. Corporations are risk averse. They might be public companies and under different scrutiny than a startup would be. And so a startup can really invest a lot of time into something that may or may not work well in terms of the ROI that seems like, okay, they're going to come and immediately be our first 5 million in revenue. That's almost too good to be true. I would say, if a deal seems too good to be true at the beginning, it probably is. And there's probably going to be more work. I mean, manna doesn't just come out of heaven and, dollars flying around. There's usually more to it than that. Now, there may be some exceptions if you really have some extraordinary technology that's never been seen before. But corporations usually come with a lot of, restrictions too when they partner, and caveats, and you can do this, but you can't do that, and so a lot of the times it might be, yeah, you can work with us, but you're not going to work with our competitors. But these five companies might make up 75% of the market. So if you're taking one big customer but foregoing the 4 others, then you're never really going to be a market leader if you're completely beholden to only working with one partner. So I think it behooves the startup to really think carefully about the long term and not just go after this immediate cash. If that large company really wants to work with you, they should be able to negotiate with you as well, and it shouldn't be a one-way conversation where the large corporate uses all of their power and to influence what the agreement looks like. And I don't think it's even in the large corporation's interest to do that. I think we have this phrase, penny wise, pound foolish. Yeah, maybe a large corporate thinks that they can use their power to milk a lot out of the startup, but is that really in the corporate's best interest? Like, you probably want this startup to thrive on its own independently as well. It's really important, I think, just to have this conversation early to understand what the limitations are, but where each side hopes this relationship can go. And then as you get down to actually signing agreements, that it is fair on both sides and it's not overly weighted toward the larger corporation just because they have more power.
It makes total sense. And before we continue in the how, I want to stay a little bit in the why we should do this. And also, if you have questions, you can scan the QR code and leave your questions. We'll reply it. I'll ask Ron your question. So, sticking a little bit with the why you should do it and what type of startup is the ideal. There's people that are building companies they want to start straight to enterprise. And I don't know if in your experience, starting a company from scratch and going straight to that more mature, complicated company is the best path, or should they go through different companies, different size of companies before trying to aspire to close a deal with a big bank, for example? So if, just giving the example here, if they wanted to partner up with BCP, does it mean they should go to a smaller bank first, or they can go straight to the bigger one?
Sure. I mean, I guess the context is very important for that decision, and the specifics around the case. You could have a company, for example, with a founder who comes out of BCP, and it's a natural relationship to start there because you already have some kind of relationship with the company, and it can get you going very quickly. So I wouldn't exclude or give a blanket rule to anything. I would say in normal circumstances, there's less risk in working with a smaller customer. A lot of enterprise software, kind of vertical AI companies start by selling to smaller businesses because if things go wrong, it's kind of less visible, and that's why you are on pilots or proof of concepts, or have these what you might call a design partner in one or two smaller companies, because they understand the startup mentality. They understand everything will not be perfect on day one, and they're willing to give feedback. So if you have a large company that's understanding, that's willing to give feedback, that's willing to help you build a better product, great. But I would say in general, smaller companies tend to be a little more agile as an initial customer, as an initial test pilot, and you'll probably get more one-to-one attention. So that's a general rule, but every circumstance will be different. I think it's very context dependent.
No, and it's definitely context dependent, because you mentioned something very clear. If the person has already experience or the connection with these sort of organizations, that really helps a lot. If you've never done this before, you have no idea what you're doing, it might be a very expensive mistake. And you mentioned something which is important: pilots. Doing pilots, getting to test your solution with these companies. I've heard a lot of different advice in the past. A few of them say, hey, aim to have the big companies as your customers, but start with the smaller ones as customers, but still ask feedback from the big ones, because they'll help you think of the roadmap that you have to build at the end. I don't know if that holds true, or again, it's also context dependent.
Yeah, if your ultimate goal is to sell to larger enterprises, the sooner you can get feedback from that ICP or that target customer, the better. If you're building for SMEs, then I wouldn't worry about that. So again, really depends on what your ultimate aim is. If your goal is total world domination, you want to serve every kind of customer, you think your product will serve a need for everybody, great. Then it's worth getting various types of feedback, as long as you don't put yourself into a corner that because you're working with one big customer, it's going to eat up so much of your time and capacity and your financial resources that if things go south, you're going to be left, without the resources to keep going forward. So that's why over-indexing in big companies early on can be risky. To the extent that you can have sort of a balanced approach, maybe it's a large company, but you're only doing a small deal with them to get started. One team in a large organization, for example, that could be a way to de-risk things. But if things go well, then you have the land and expand approach, where you can start selling to other teams within that large organization.
That's awesome. Just like VCs do due diligence on startups, should you advise startups to do due diligence on the corporates they're going to work with, especially if they already have done partnerships in the past with other startups?
Yeah, you certainly want to know what a company's reputation is. Large companies in particular, I think it's pretty easy to decipher. Are they a friendly partner for startups? Do they have experience investing in or working with startup companies? Do they make it part of their culture or their ethos that they want to encourage innovation by partnering with startups? Many larger companies will do that, but you need to be careful, because there are other larger companies that, again, are more about using their power to negotiate the most favorable terms possible. And I've seen sort of all sides of that. Ultimately, I think in the long run, you really need to be on the same wavelength. Again, a lot of entrepreneurs come out of larger organizations, so they might know how to navigate them, and many will end up selling or partnering with the company that they came from. So that's a great entry point if you can do that, because you already understand the organization, and you're not really flying blind as you enter these partnerships. So I would use that to your advantage. I would also find other members of your team, advisors that are connected to larger organizations, if that's what you want to work with. Getting that warm introduction, that more seamless, organic path into a relationship is always much better than going in cold and just taking the risk and the hope that this corporation is going to be mission aligned with you, which in many cases it will not be.
I find a lot of similarities between the VC space and the partnering with startup space between corporates and founders, because both have to do due diligence. You have to understand the company. If you're a corporate, you want to see a little bit of the financials of the startup to see if they're going to be there tomorrow, because I understand as a corporate, it's risky if a company is not going to be around in 6 months and you're putting too much resources, and especially time and reputation, because you're asking someone to be your sponsor, you're sort of betting on this company. The same way as founders ask other founders reference from those VCs, like, is he a good investor? Is she a good investor? Are founders doing the same, asking the corporate, like, can you refer me to other companies you've done partnerships in the past, or is a practice that is not really well done?
Yeah, I think that definitely more due diligence, the better. I think the question is, how is this going to be perceived? And I think there's two ways of looking at that. So if I, as a VC, am talking to a founder and they start asking me more questions than I've been asking them, I kind of think in two ways about that. One is, who the heck is this arrogant upshot asking me? I'm the guy with the money. On the other hand, it's like, if he can afford to be asking me all these questions and doing diligence on me and pressing me for good answers, that probably means that this entrepreneur has a choice of which investors they want to take money from, and I need to compete because this is going to be an oversubscribed round in a very hot company with an entrepreneur who is confident enough to feel that they don't need my money. So I think the latter actually works well if done in a way that doesn't come across as too arrogant but really genuine. And I think some of that can actually be done back channeling. You don't necessarily even need to ask the company. I think sometimes you can sort of figure out what other startups they're working with through, the media or different channels, or ask ChatGPT, they might know. But if you can do, more due diligence, better than less. And sometimes, asking that question is a good thing. I mean, if I know that I'm competing to be in an oversubscribed deal, I'm more likely to prioritize it than one where, they're basically begging for money. So, there's a little bit of a game that you can play of perception around, your viability, and maybe you are the only ones doing this, and maybe that corporation actually needs you more than you realize.
Before taking some questions from the audience, I want to jump into more of okay, now that I'm interested in working with this corporate, what's the next step? And usually is, show me a demo, I like the demo, let's do a pilot. And then it sort of stays there, stagnates over months, doesn't progress. But at the same time, most of these pilots, they're done for free. And I have this position where, should we do it? Our pilots, should we do it for free? At the same time, because of the dominant position of the client that you want, they'll say, well, if you really want the account that you're going to win, then do it for free. So, what's your position on those steps, and especially the investment on the startup and corporate side?
Yeah, it's a great question, and there's not always the one right answer to that. I think you can create a perception of scarcity by going to a pilot and saying you're only getting this pilot if you pay for it, because I've got 10 other companies that want to do the same thing. So, I'm not a charity here. So, you can certainly take that as one approach, and it might very well work. Again, if you've created something that compels them enough to want to try a pilot, a $10,000 or $50,000 contract might be a drop in the bucket for them, and something that they can get approved quite easily. On the other hand, in the earliest stages, me as a VC, I'm honestly more interested to know what the company feels about the product before I want to know what their willingness to pay is. So I want to know, a great question is, if I'm doing due diligence and I want to go to the customer of, say, a software startup, and that's already been using the product for, say, 6 months, I might ask them, what would you say if I were to turn off the product tomorrow and you wouldn't have it? Would you feel like, okay, I'll go on to the next guy and no problem? Or would you say, oh, hell no, how can you possibly turn off this product? I'm already hooked on it, right? You can learn a lot by asking these questions early, and sometimes it's more valuable just to get customers using it, to understand, are they going to continue using it? Are they going to tell other teams internally that they should be using it? So that kind of feedback, I think, is more important probably in year 1, even year 2, as you're building and testing and iterating and developing this product than actually the revenue. I would say once you're generating revenue, investors are going to expect you to be growing very quickly. So once you turn on the revenue, you have switched from the point of being an idea, so an investor investing in an idea, to an investor investing in a scale-up. And that's an important, inflection point that you want to consider when is the right time for. So to some extent, it might be to your advantage not to take payment right away because you really just want to prove the product itself and learn from that and iterate on the product before you actually decide it's time to start selling, because once you're selling, you need to start growing that sales very quickly or investors are going to think you're stagnant.
Perfect. Yeah, and again, there's always never that right answer, and sometimes you have to sort of feel it to see if that the decision you're taking will bring you to the right conclusion. But that's part of the challenge of being an entrepreneur. You don't have all the information up front. You got to take the best bet that you have on the moment. We have a lot of questions from the audience. They're really good. I've had to sort of unify a few of them so they don't repeat themselves. But let's go. Some of them want to know about your investment style, the types of companies that you've invested. So what are the main challenges of investing in deep tech? And what key lessons have you learned from investments like Aura Ring, for example?
Okay, so someone's done some research.
Apparently, yeah.
Alumni Ventures invested in the Series B round of Aura. It's now up to a Series E at a multiple of the valuation at which we got in. I didn't personally work on that deal. It actually happened before I joined the firm, which has been 6.5 years, so I think that investment was probably 7 or 8 years ago. And yeah, I don't even know if I would consider that necessarily deep tech. I've also invested in quantum computing and space technologies and hardware and other, but anyway, be it as it may. Yeah, certainly a lot of challenges to deep tech. This is true high risk, high reward investing. This is all about moonshots, but that's why we're in venture capital. So venture capital is really the only asset class out there that relies on something called the power law. So the math of venture capital is really unique because we as investors go into investing and building a portfolio knowing that many, if not most of our investments will actually fail and go to zero. But that doesn't deter us because traditionally what we've seen is if you pick enough of the right companies that are of these moonshot nature, that at least a couple out of a larger portfolio will do so phenomenally well that you could get a 100x or more return on your money, and one investment can return an entire fund out of 20, 25 companies. I've experienced this myself. This does actually happen. And as an investor, as I look at deep tech, these are the most moonshotty of the moonshots. The outcomes we expect will be binary. Either it will be a huge phenomenal success or it will be zero. And so there is often technology risk, there's market risk, there's team risk, there's macroeconomic and sometimes geopolitical risk. For example, I've invested in space technology, and one company I've invested in is very reliant on what will happen with SpaceX and their contracts and their deals, because a lot of their revenue is going to be correlated with their success. And so there's a lot of risk, but I think as an investor, particularly at the early stages, at the pre-seed and seed stages where I invest, it's important for me to build a diversified portfolio. So I have a new fund every year. I'm currently finishing investing out of the 8th seed fund of Alumni Ventures, and we're just finishing now, at the end of this year, we'll finish raising the 9th seed fund, and it will be a fund of over 50 companies. And this is a one-year fund, so that means my team will be making at least one new investment every single week on average. And so we can afford to take risks. We can afford to say, there's something compelling here. There's a big addressable market, a technology that seems compelling and defensible, a founding team that seems highly relevant, And we're also a co-investor, meaning we look for other firms to actually lead the round so we can gauge how successful they have been in their past investments. We put all of this together into a scorecard and come out with some kind of number that indicates to us whether this is worth investing in or not. But we have to do this in a diversified way. If we only did 1 or 2 or 3 investments at this stage, we were going into the fund knowing that there's a chance we could get nothing back. And that's not acceptable for us. For us, the reason an investor wants to be in venture capital over less risky, more traditional assets is because historically it has outperformed other asset classes. And so the way we get there is by having enough companies out of a large portfolio do so well that it makes up for any of the losses. So we need to have a large, well-diversified approach, and that I think is particularly true when investing in deep tech, especially at this sort of pre-seed and seed stage, where many of these companies are still even pre-revenue.
I mean, that's really amazing. I've had the opportunity to talk to a lot of people more in the traditional space, and when you talk about the VC math, it's just mind-boggling for them. It's like impossible to think that you're investing and already saying 1 out of 20 or 1 out of 50 is the one who's going to pay the whole fund, and I don't give a damn what happens to those that don't work.
It's certainly not our intention. We wouldn't invest in any one of these companies if we expected that to be the case. We're just realistic. And
the math.
That's the math, and that's the history of venture capital. So, you could go look up one of the best and oldest venture capital firms is called Bessemer Ventures, and they publish what's called the anti-portfolio, companies that they missed. But, you're going to miss them both ways, right? You're going to take a big swing on things that fail for reasons that you never would have anticipated, and you're going to not invest in things because, we're not Nostradamus that can predict the future. We're doing our best, using our best judgment, using the research and tools available to us to make an estimated guess at which ones will work, but we're never going to get 100% right. It's a very humbling business to be in venture capital, but it's like, I don't know if any of you follow baseball, but if you bat 300 in baseball, which is you get 30%, that's actually doing pretty well. You might be an all-star with a 300. And venture capital is kind of similar in a way, but 300 is still better than 200. So we still need to do our best effort at getting more than the others right.
Yeah, I've heard that it's not much about getting it right or not investing in that company versus the one that you did invest. It's about having seen all of them, not missing one that you didn't see. So if you missed on Facebook, it was not because you passed on Facebook. It's because I didn't know Facebook existed, and that was an option.
Yeah, and the best in this business get them wrong. And I don't know how much I should tell tales out of school, but when I raised money myself for Travel Perk when we were a startup, I pitched some of the best VCs out there, and some of the best top names VCs that I could mention passed. Now, some of them might say, okay, it's too early or this or that. But ultimately, they passed, and they could have gotten in on a deal at a tiny, tiny fraction of the valuation of where it is today. And maybe, I'm sure there are reasons why they passed, and 9 out of 10 of the investors that I pitched early on did pass. But that's nothing to be ashamed of. It's just humbling, and it just, it should be a reminder that we're never going to get everything right, no matter how hard we try. But we're going to do our best to pick the ponies that we think, with the best information we have today, we think have the opportunity to get to that kind of 100 or 1,000x potential.
Well, you've been in both sides, so you have sort of the empathy that it takes to know that when you're saying no to someone, it's like, that's what I think with the information I have, but you have to take the call. And I've been in both sides as well, so it's hard sometimes because you don't want to sometimes tell the founder the reasons why you're not investing. Maybe we should, I don't know, but there's a lot of, in this space of venture capital, of trying not to close doors. So a lot of VCs, I don't know if it happens a lot in the US, but at least in Latin America, we tend not to say no. Not only in venture capital, but in general, the Latin American culture is avoiding saying no. And it's terrible in venture capital.
You'd make great venture capitalists then, because that's all I do is, I very rarely actually say no. I say, come back to me when you have a little more traction and this is what VCs do. And on the one hand, maybe that's not very transparent. On the other hand, there's some element of truth to that, is that if you can prove that you can really grow this thing, like right now, as of today, maybe I don't believe you can grow 10x over the next 2 or 3 years, but if you can prove to me that you can, I'm going to reconsider. So yeah, maybe it's a good cultural fit.
Maybe you're Peruvian. Too much ceviche. Let's jump to another topic, more about scaling and how to continue innovating. So how can a startup scale quickly, especially in emerging markets where we are, but without losing the flexibility you need to keep innovating?
Yeah, great question. So if you've got, especially a technology company, if your ambition is to scale, you want to eventually be a public company, you want to be a unicorn, growing quickly is something you're going to need to do. Yes, there are companies that can be built over many years and so forth. But and by quickly I mean going from inception to IPO in 10 years, I would say is very quick. So I don't mean you need to get to IPO in 2 years, but 10 to 15 years can be a reasonable pathway, and that's still pretty fast. But it does mean you have to make a lot of decisions along the way. And I think, a lot of it really depends on how quickly you can get to recurring revenue and gross margin profitability versus how quickly can you raise money. There's a lot of companies that could scale if they can raise 10 million followed by the next round of 30 million followed by 50 and then 100 million. Sure, if you can do that, you can probably scale quickly. Not everyone can do that though. So there is a little bit of a balancing act because you always need to hedge a little bit. What if I can't raise that next round of funding? And you may believe in the idea, but investors for whatever reason may not. And so you're stuck. So then you have to kind of grow organically or find alternative sources of capital, maybe venture debt or something else. So it's tricky. And I think it really depends on what your trajectory is and how well connected you are. Do you know the VCs that could potentially invest in that growth? If you can afford to take more risk because there's maybe a better chance you are going to be able to raise that next big round. So I think you kind of have to gauge for yourself how likely it is that you're going to be able to raise the big funding rounds versus having to fall into a position where you need to grow organically. Or are you going to say, hey, I'm going to go all in. Either this thing is going to scale like crazy or I'm not going to bother. So then you do have a higher burn rate, but then in 12 months you're going to run out of cash if you don't raise the next round of funding very quickly. So I think, again, there's not necessarily a one-size-fits-all answer to that, but I think if you have the capacity to raise that capital, if you're very good at selling customers, selling investors, go all in on the growth. If you think you're going to be challenged by that, then I think you need to kind of have a plan B scenario in mind where it's a little more organic and you need to be a little more risk averse and say, okay, maybe I'm not going to be an IPO in 10 years, but there's still a path to get there in 20 if I have to grow there organically. So I think always have a best case, a medium case, and a worst case business plan in mind.
Awesome. So let's go a little bit more on idea stage, validation, pivots, and even closing, if necessary, the company. This is a question that also might fall in its context, or it might vary based on the situation, but a lot of founders face this situation anytime soon at the beginning when they don't know how to validate their idea. They can do they don't know if they've managed to have product market fit, and they've been doing this company for a while now, and they face a challenge to either stop doing what they're doing or pivot. And I know there's the Silicon Valley mindset of, do it for a year, maybe 2, if it's not working, close it, start something new. At least in Latin America, you see people trying to pursue this until you manage to be successful because of the perception that if you fail, you're a failure forever, versus Silicon Valley where they celebrate failure. I don't know if the East Coast is like the in-between, but what would be your suggestion for founders that are in that early stage and are not really achieving that product market fit?
Yeah. So product market fit is kind of an amorphous concept. You don't ever exactly know when you have it, but at some point you can sort of look back in the rearview mirror and realize, okay, I guess we found it here. So it's much easier to look back and see when you identified it than looking forward or even in the moment say, okay, we found it. Now, a lot of entrepreneurs think they find it or they have a hypothesis of when they get it, and I think there are indicators of that. You know, do you have very high retention rates of your customers? Do you have customers calling? Do you have a backlog of orders that you need to fill because there's so much demand for your product that you can barely keep up with it? And you need to raise money purely for expansion, not for survival. Those are kind of the indicators, but there isn't like one single dot moment where it's, okay, this is product market fit. So that's something you have to be very in tune with. I think as you consider pivot, you know, there's different kinds of pivoting. There's sort of tweaking on who the target customer is. There's sort of, hey, you know, we need to, you know, adjust our ICP. It's not maybe the automotive industry, but it's the aerospace industry we should be targeting because of XYZ reason. That can be some kind of pivot. Or you can have a drastic pivot where say, you know what, we failed, we still have money in the bank, we're still entrepreneurial, we've learned something from this, but now we're going to try something completely different. And that can work. There are companies that have pivoted their way into success. As I mentioned early on, you know, the first version 1.0 of Travel Perk is not what it became. Our vision actually expanded, and I've seen this with startups I've invested in. Now, it can be hard to go back to one of your investors. This is a challenge. If I have a founder come back to me and say, hey, we've completely pivoted, but now we really believe in the idea, you know, one side of my head thinks, well, if you had it wrong the first time, how do I know you have it right the second time? On the other hand, you know, some entrepreneurs are very smart, and they really have lessons that they've learned from it and have really identified something new that tells me, okay, maybe they are onto something, and you know, that's more resourceful and more gritty than just saying I'm going to give up and forget it and just return whatever money's left to the investors. So sometimes I am willing to invest in a company that goes through a drastic pivot, but I think it's most important as an entrepreneur to be really honest with yourself, because you always have to be selling. You're selling investors, you're selling partners, you're selling customers, you're selling employees. You're always selling. So to the outside world, you always have a sunny disposition that everything's going great. But you have to be honest with yourself and with your co-founders and even your investors on whether things are actually going great or not. And if they aren't meeting your expectations, what can you do about it? And is there a pivot that actually makes sense? Because you've really learned something material that helps inform, that leads you to a better product or a better vision than what you had previously. And you know, at that point, it's up to you to try and sell that new vision. And I think you'll learn very quickly whether that's going to work or not.
That's a great advice. Changing gears a little bit, I'm very curious to know, in your portfolio, in the past, now, do you have unicorns already? How many?
How many? Yeah, that's a good question. So across Alumni Ventures broadly, and I've worked on different teams. Before I was on the seed fund, I used to work on one of the other funds. So I've kind of moved around, and it takes a long time to invest in companies that actually become unicorns. You know, my company, Travel Perk, became a unicorn probably 7-8 years into its existence. That's fairly quick. I've also invested in companies. So I invested in one company on the prior team I was on at probably around the Series A to Series B, before, you know, well before it became a unicorn. This company called Sunbit, which does buy now, pay later for things like a visit to the dentist, a visit to the auto repair shop, a visit to the vet, things that people don't necessarily anticipate or budget for a large sudden expense. So they're there to provide immediate financing for that. They've executed really well. It's almost more of an execution story than a tech story. There is a tech story to it too, but it's just an execution story. So this is one. But across Alumni Ventures, we've invested in companies that have gone public. This year, we had a company called Circle, which is kind of a stable coin crypto company that went public, has been a very good outcome for us. We were in another company called Rigetti, which is in quantum computing on the hardware side. that actually went public through a SPAC a couple of years ago. The public market wasn't too friendly to it for a while, until all of a sudden it was, because of some of the innovations and developments. We had held on to the shares, even though our typical thinking is to sell after 6 months, after the lockup period when we're allowed to sell, but we didn't feel that the public market was respecting the full value of the company, so we held on, and we didn't start selling in a programmatic way until the market started recognizing the value that we appreciated in it. And so that's a success story. Aura, of course, another unicorn. We're in Lambda, Cohere, Grok. So we're in some of the AI unicorns. No matter how many we've done, we want to be in more. And there's always opportunities to do more, but we've definitely invested in our share, and a number of companies that have exited and kind of gone in that unicorn trajectory.
Do you know how many unicorns we have in Peru?
I've heard 0.
So the question is, why? Why do you think that until now we don't have a unicorn in Peru?
Yeah, great question. I mean, I am seeing, startups out of Chile, Argentina, Colombia, perhaps some other countries in Latin America where there are unicorns. Ultimately, I think it's not necessarily about the entrepreneur. I think it goes hand in hand with a funding ecosystem. My understanding is that the venture ecosystem is not very well developed here. And to have a real venture ecosystem, you need funding at all stages. That means individual angel investors. It means early stage seed investors like myself. It also means growth stage investors that take the companies that are doing well and are investing in the trajectory that gets them to an IPO and unicorn status. You need that whole ecosystem. But that also has to be backed up by really great ideas, an entrepreneurial culture, a willingness and a tolerance for risk, a desire to pursue advanced technologies. So having that, the universities that have great engineers and technical talent, all of these things kind of need to come together in the right way to make it happen. So I don't want to assign any one thing. Maybe there's a little bit of, government. Maybe there's a little bit of investment community, a little bit of the entrepreneur, a little bit of the academia. It's maybe a little bit of everything together. So I'm not expert enough to know for sure where it comes from, but usually it's not just one thing. It's sort of a whole ecosystem that has to be built. But ultimately, I think from a cultural standpoint, that willingness to tolerate risk and failure and to even celebrate failure is an important part of achieving success. So I don't know, you can tell me more about Peru, but I would hope that there's some element and maybe a growing element to accept that risk and a willingness to take it on and to even celebrate the entrepreneurial attitude that would pursue businesses that could ultimately become unicorns.
It was worth giving the shot on that question, and I come out as happy of doing it, because there's no right now formula. If we knew the exact formula, we probably would be now trying to cook it. But I agree with you. There are several factors that are involved, and I would go more into one root cause, which is the tolerance for risk. And I think that will go across all the sectors, because if you're a founder and you're risk averse, then you're not really a founder. You don't want to jump into doing something that you're not happy to do, even though there's uncertainty. The same goes for investment. Like most of the people investing in Latin America want to go more into a traditional safe bet. Even they want to diversify the risk, moving their money abroad, say United States, Europe, and places where they have a financial ecosystem where you've in the past have shown that are more resilient to volatility, government-wise and so on. But that's something we should change. So how can we help these more emerging ecosystems be more comfortable with taking risks, especially in this sort of sector, technology risk?
Yeah, I mean, I think ultimately it's the entrepreneurs themselves have to go out and do it and make entrepreneurship a common, respected choice of career. I mean, even in the US at one point, it was thought of as just, something crazy, very risky, something only a few people, maybe in Silicon Valley, kind of did. But then because there were enough of them, there was enough volume of entrepreneurs starting businesses that sooner or later enough of them clicked and started working that you started to see the success. And it almost became that entrepreneurs turned into celebrities and billionaires became celebrities because they've made all this money, and you could argue whether that's something worth celebrating or not. But then, you know, you had like the Social Network, the movie about Facebook and Mark Zuckerberg. And, you know, in some ways, he comes across looking pretty bad in that movie. But most of the people came out of that kind of motivated, and that I know, at least inspired, like, hey, I want to do that. Like, you can come up with just some idea, get a few things organized, and suddenly you have this huge company that's changing the world, and everybody's using and talking about it. And those things actually do happen. But, you know, if you're not taking enough shots on goal, you're not going to get there. So you just need, I think, first and foremost, more entrepreneurs to be starting companies that are taking big swings, that are going for, you know, maybe riskier ideas and thinking about things that are going to scale and that are not necessarily just serving the market in Peru or even just the market in Latin America, but are things that can work globally. And think about where am I really innovating? What am I doing that's different? There's no shortage of good ideas out there and good scalable ideas. It just takes entrepreneurs willing to actually do them. And then with that, my hope for the local ecosystem is that there become more investors that are willing to take this on. And so, you know, I don't really know where the money lies completely, how much there's in family offices or high net worth individuals versus sitting in banks or corporations, but all of them play a role in a willingness to say, hey, I want to invest in Peru because I believe in Peruvian entrepreneurs. I want to invest in them, and I understand that there's risk involved in doing this. But I think, you know, in some respect for the greater good, I think the economy will come out better if we have more money going into these startups. And maybe the government can have a role in providing non-dilutive grant funding as part of this. Some countries are very good at this. Some countries do less of this. But that can help stimulate the economic growth as well. And just creating something like, you know, an ecosystem like, you know, I'll use the example of Israel, where they are so, entrepreneurship is so ingrained. Now, it's very cultural. They kind of come from a world where they're kind of always at war with their neighbors, and they've all gone through the military and trained. And, you know, there are a lot of reasons why in Israel it's turned out that way. But they are like a unicorn factory. But it's not only Israel. Do you know, I'll give you a trivia, so you asked me a trivia question, I'll ask one to you. Which country in the world has the highest per capita ratio of unicorns to GDP?
Israel?
It's actually not. It's actually Singapore.
Oh, wow.
And Singapore has been a country that's, you know, really been a very sort of capitalist, free market, you know, investment savvy, willingness to take risks and be on the cutting edge of technology and be on the forefront of medicine. And it's a small country, but with a lot of this, you know, desire for growth. And, you know, the question is, how do you replicate, whether it's Singapore or Israel or Silicon Valley? And you're never going to fully replicate, but you can take lessons from that. And some of it might be cultural, and culture is a tough thing. But it's, I think, everyone kind of coming together, academia, government, investors, entrepreneurs, and saying, we have a mission to change. We want to stimulate more jobs, more economic growth because of this. So, you know, how do we do this? And can we form, you know, almost like a steering committee to come together and say, how do we leverage all of these aspects to grow this?
I know we're getting a little bit off topic, but this is more because of my curiosity, so please bear with me. But we've been talking a lot about how do we replicate Silicon Valley or Israel, now Singapore, in Latin America. But I don't know if that's like the correct path versus why not Latin American entrepreneurs go to those more mature markets. I myself went to Silicon Valley, and it's like playing the big leagues, and it's fighting really big, tough entrepreneurs and startups. What's the best path? And again, probably you're going to say, oh, it depends, the context, but tell us, what would you do if you were a Peruvian today sitting here? Will you start your company here? Will you go to a more mature country?
Yeah, I mean, I think there are a lot of ways to slice that, but I think in some respect, if you have the opportunity to do it in the U.S., there there may be something to be said for that because there is a more mature venture capital ecosystem. It could be easier to become part of the Y Combinator, cohort that then gets you in front of a lot more angel and VC investors, that gets you, onto TechCrunch and some of the news articles that people like me read. And so if you can build a story as a Peruvian entrepreneur in the United States doing well, that will help translate to the Peruvian ecosystem, because that story is going to become well known here, hopefully, and you're going to come back and you're going to want to pay it back. A lot of entrepreneurs, once they have their success, they start returning that to where they came from. They start investing in other entrepreneurs, and so there's plenty of examples of foreigners coming to the U.S. doing well and then going back and or then reinvesting in their home country. So that's not necessarily a bad strategy. It could also benefit Peru here in that maybe you want to hire developers here locally or have, a lot of your staff here, even if you, as the CEO, are maybe sitting in Silicon Valley because you're closer to where the money or the customers are, but you can still have your team based here. So there are a lot of ways to think about it. And even when I was doing the travel perk out of Spain, I was in Barcelona. Our lawyers immediately told us, you're American, you should actually make this a US entity. And that was actually worked out as a great idea for tax and legal and various reasons. And you might want to look into that if you're doing that. Different ways of slicing it. I wouldn't say that you're doing a disservice to your home country if you were to decide to go and start a company in the US, for example. There could be very good, valid reasons for doing that.
That's really awesome. And the idea that you can start a company in your home country, but serve a larger market, but still have your staff, your workforce in your country, you're leveraging on this difference between the arbitrage between what some founder in Silicon Valley is paying millions for a developer, when here you get the same or even better quality of developers at a better price. But also, something interesting that I've started to see a little bit more now in Peruvian founders, which I saw a little bit in Mexicans or Argentinian, Uruguayan founders, is why not start a company and sell directly to the United States? Why not Latin American technology going head first into the US market? And that's happened right now with my latest investment. 6 months in, they pivoted. Bye-bye Mexico, Peru. Let's go straight to the US. Let's win the US and become a global company, and then come back and win some deals in Latin America.
Do it. I mean, that's exactly the strategy of Israel. If you look across all the unicorns, IPO big companies in Israel, almost every single one of them is first and foremost selling in the United States. Maybe in some cases it's a little more Europe, but they are not selling to the Israeli market. That's kind of an afterthought.
And it's small, and it has the same limitations as the Peruvian one, I guess. And the same as we are giving advice to founders about their strategy, how to become global, and targeting these companies. Switching now to corporates, if they want to do corporate innovation. So for the corporates sitting here, some might say, if I'm a corporate in Peru, I have to work with Peruvian startups. But that's a bit limited. I know, for example, OSP is working with startups all around the world. They even have CVC called Créalo, Credit Corp has a CVC called Créalo, which invests in companies from all Latin America. So what should be the advice for corporates if they want to do open innovation? How do they can really get to work with companies that are beyond their borders?
Yeah, there are many different ways that corporates can think about innovation, and I think it's important to recognize what it is, what kind of innovation you want to do in-house, and what have you decided. You know what? There are things that we're interested in. We want to explore, maybe do some R&D, but we don't have the resources in-house, or for whatever reason we don't want to do that. Who can we partner with, and think globally about that, right? If you have the world of options of startups, whether they can be in Peru, they can be in a neighboring country, they can be in the United States, think very broadly about that. And how are you going to partner? Are you going to be a customer? Are you going to be a channel partner? Are you going to do a strategic deal, like a revenue share kind of platform? Are you going to invest in the company? Are you going to do a combination? Are you going to incubate the company and let them use your office space and give them advice and mentoring and a lot of different ways to partner. And I think that's great. It can be a real win-win if it's executed correctly. As a larger company, you get to test different technologies, different innovations that might eventually benefit you and be something that you want to lean into, and then you might have the opportunity to acquire this smaller company. But it also de-risks in the sense that it's kind of the R&D line. It's you don't have to report back on how much money you're spending, and very often with startups, for a larger company, the amount that you might invest into a project is really de minimis. It's really like a non-factor and a rounding error. But $100,000 to a large company can does not even appear on the P&L or the cash flow statement, basically, because it's all rounded. But for a startup, that means getting a product to market, launched. You can really do a lot with that. So I think it's terrific for corporate venture arms to think about how they can leverage the creativity, the passion, the drive, the hard work of entrepreneurs and help incentivize them and help push them forward while you also benefit from some of the technology that they're building.
You've just mentioned about investing, and now we're talking about the corporate world. What is your take on corporate venture capital? Meaning how corporates are investing in startups just or similar as what VCs will be investing. There's a lot of talk about what type of signal that sends, if that actually helps validate or not validate the company. What are your thoughts on this type of investment?
Yeah. So just to frame it, I really think there's kind of sort of two kinds of corporate venture capital. There's that which is sort of profit-seeking and kind of more generalist. Take Google or Google Ventures or Gradient, kind of their AI venture arm. Microsoft Ventures. They kind of invest for returns because they have so much cash on the balance sheet that it's kind of like, okay, well, we'll invest in some innovation across a lot of different categories because we serve all these categories, so we can do that anyway, while also seeking a return for the balance sheet cash. And then there's the more strategic corporate venture capital, which is probably more representative of how CVC works, which really represents how a lot of pharmaceutical companies invest. Novartis, Pfizer, these kinds of companies, they have CVCs, and then there are other larger corporates in entertainment or media or the automotive industry, Toyota Ventures, GM, Ford Ventures, et cetera. And they're doing it maybe for more strategic reasons because they're investing in companies that they perceive as potentially suppliers or potentially even competitors, and they want to get ahead of stuff because they think that there's innovation in their market that could eventually help them. They're not going to go all in, but they see reasons to be close to that company, to not just have a financial stake because there could be financial upside, but also because they want to be close to potentially invest and maybe acquire that company someday, or be an exclusive customer because maybe they don't want their competitor to get involved. So if they're an early investor, they might prevent that startup from selling to a competitor, so they would get a competitive edge on the technology. So yes, it can be a strong signal. It does come with some noise and potential conflicts of interest around it. I, as a VC, because my firm, we only co-invest. We tend to invest alongside more traditional VCs. We look at a CVC investment as interesting, but not necessarily the signal that we look for because we are return motivated. We want to be aligned with the interests. So if an Andreessen Horowitz or Khosla or Sequoia or Bessemer, one of these types of firms is leading around, we have a good sense that our interests are aligned with theirs. With a CVC, that might not necessarily be the case. But that's kind of specific to how we view the world and our investing strategy. But as a founder, if that's your best option, take it for sure. But also weigh the pros and cons. If you have lots of different options at the table, the CVC might not, in fact, be the most strategic option for you. If it might preclude you from working with, for example, competitors down the road by taking money from one CVC.
Great. I have a couple more questions before we finish. The next one is, again, a little bit more of my curiosity on how Alumni Ventures operates. How do you guys add value to the portfolio companies? And especially, how is it that you're able to co-invest in this very highly competitive rounds where you've just mentioned, you got Khosla, Andreessen Horowitz. Usually you hear all the Silicon Valley stories about fighting for term sheets and who gives the best valuation, who has the best brand. In Latin America, it's more like who at the end is willing to take the risk, not because you were the fastest. Sometimes founders have to take what is on the table. So how it is that you manage to be very competitive in this environment?
Yeah, great question. I mean, we kind of have long been advertising our volume. We've been ranked by PitchBook, which follows our industry, as the #1 or 2 most active VC firm in North America, et cetera. In the last couple of years, we've also been ranked independently by some research outlets, CB Insights, more recently Time Magazine actually, that ranked all of the North American VC firms, and both of them put us as one of the top 20 VCs in the country. And that's honestly not because we're a team of geniuses, though I like to think we all have our special skill sets, but a lot of that is based on the model of co-investing with the best firms, the top quartile type VCs. Not every deal we do is top quartile, but we sort of aim for that level of investment. And we do try to get into the most competitive rounds, even the rounds that are hard to get into. So there was a famous quote by an old American comedian named Groucho Marx, who, I don't know if any of you have ever heard of him, but he famously once said, "I wouldn't want to be a member of any club that would have someone like me as a member." So I very often don't want to be in the deals that are very easy for me just to get into. I want to get into the ones that I have to fight and argue my way into and tell a story of why they should accept our money. Now, fortunately, most venture rounds have multiple investors. So there's typically one lead or maybe 2 co-lead investors who write the biggest checks. They're going to take the board seats and so forth. And then there's usually room for a few other strategic value-add VCs or corporate investors or maybe strategic angel investors or what have you. And that's where we play. We are only a co-investor. We never set terms. We look for another well-established VC firm to lead and set the terms. So we have to fight our way in for remaining allocation once probably at least half the round is already in place. And then we're fighting with other co-investors. So our mission, our goal is to be the world's most impactful co-investor, which means we do not look for a board seat. In fact, even if you offered it, we won't take it. That's not where we feel we add the most value. Our value, where we are unique, is we are the largest venture capital firm in the world for individual investors. We brand ourselves for individual high net worth investors. In the US, we call them accredited investors, which basically means you have either $1 million of net worth or you make at least $200,000 a year. Basically, there's some other details, but that's basically it. And that's who we work with. But because we have marketed ourselves toward individuals, we are very public and very transparent, and we publish a lot of content. You can go to our website and find dozens upon dozens of webinars, blogs, all kinds of information about venture capital, startups, technology, innovation, entrepreneurship, all of this good stuff. And we're constantly refreshing it and doing new content on all kinds of different topics, from food tech to space tech to biotech, kind of AI, you name it. We try to cover a little bit of everything. And in doing so, we've built a very big community of followers. So I don't know if there's another venture capital firm out there that has as many opt-in followers as we do. Maybe there is, and I'm just not aware of it. But we have over 850,000 people opted into our email lists. They follow us on social media, and LinkedIn primarily, but other channels as well. And because of this, we get to know who some of these people are. And within that, there's a subset of experts. We call the Alumni Ventures Expert Network. We have networks of scouts, of super angel partners, of venture fellows, all of these people who are our stakeholders and contributing to what we do, in addition to our 11,000 individual investors and 1,600 companies we've invested in. It's a lot of entrepreneurs and founders that are all part of this huge community and network. So we can tap into this, and we have built a team that we call CEO Services, which in venture capital we call our platform team, that's here to work with our founders in whatever asks they may have besides the board stuff. where we help with warm introductions to partners, experts, talent, whatever it may be. We organize events to help promote our portfolio companies. We do webinars with them where we interview them and talk to them. We help them publish content. We help them get ready for their next funding rounds, make introductions to other VCs, all kinds of things that we do to be kind of a supportive aunt or uncle kind of relationship where we're just here to help. And that's really our role. And that also helps us get into subsequent rounds. But that, that reputation is what allows us to have our own niche, our own brand within the venture capital world, and hopefully helps us. So, sorry, long-winded way of answering. That's kind of how we try to get into the most competitive deals.
I mean, reputation is everything in this space, and it's nothing that you can. It takes a while to build. It's easy to unbuild in seconds, but it takes a while to do what you've done. And so, congratulations for that. One last question, closing question. Do you like ceviche? No,
being invited to Peru was a dream come true. I would eat ceviche every single day. And I don't get much pisco back home either, so I'm ready for this evening.
It was a good question, but I was also kidding. I think there was in a press conference, somebody asked that. I was like, what kind of professional question is that? But
I love the curveballs, so bring it on.
One real one to finish, and I think this is more of right now what's happening with the advancements of AI. There's been a lot of trash talk about most startups are just wrappers of the LLMs. I don't know if that's the big companies trying to avoid competition of startups, but for those that are building startups using AI, and want to win corporate deals, like how can they navigate with this narrative that they are not building true innovation, that most innovation are coming from the big frontier LLMs? What's your take, and what's the advice for them?
Yeah, so probably at least half the deals I've invested in the last year have been kind of AI first deals, and they're not all LLM based deals. We also have AI and visual manufacturing inspections and all kinds of applications of AI. But within that specifically, yes, there is an element of building upon this great technology that's there and it's ready. And yeah, there is a risk if that's what you're going to do. You're going to take kind of an LLM data set and tools and use that to go deeper into a particular niche or vertical. The risk is that the bigger companies can come and do that as well because they are extremely well funded, almost to an unprecedented level that's sometimes hard to believe. So there's the risk that they can also each start pursuing these individual verticals. On the other hand, where you can really compete is on the data. If you are really deep, if you really know a particular space very, very well and have access to some sort of proprietary data, or you're able to use that data in a way that's, creating algorithms that no one else has done, and you can stay ahead of that market, and you're close to the customers. The competitive mode is not necessarily only the technology or the data, but it can also be, your market strategy and just being really, really close to a particular market. There's enough verticals out there that there's room for a lot of players. I would almost worry more about competition from the other companies, because if you've thought of it, odds are a lot of other folks have too, even within your particular domain. So I would just be wary of how are you going to compete and stay ahead, because ultimately, the best product I think is going to win each market, and if you want to become that platform for that industry, you really need to be the best, and you need to move quickly. So just really think about how your advantage today is going to remain an advantage 1, 2, 3, 4, 5, and more years out. Awesome, Ron. That was a great way or segue to closing this event. Thanks again for your background, your story, the insights you've been sharing. I hope this inspires everyone here, sitting here or watching, listening to you, to want to start companies, partner with corporates, or corporates wanting to start to entrepreneurs. And if anyone wants to reach out to you, what would be the best way? Yeah, absolutely. Please connect on LinkedIn. You should find me pretty easily, Ron Levin. I think I'm the only Ron Levin venture capital guy. But don't Google me, because there was actually a very famous Ron Levin who was actually a con man who disappeared in a mysterious way. And they've actually made 2 movies about it. So that's the infamous Ron Levin.
See,
Hopefully you can
Tony,
remember
I told
me,
you
so.
to not do that. That's why in the bio it said that when we're doing the event.
That's why you have to go below the first page of Google search results sometimes. But anyway, that's one way. I'm also happy to give you my email, which is ron@av.vc. If you want to reach out, please tell me that you were here. I do get a lot of cold email, a lot of cold messages on LinkedIn. I don't have time to respond to everything.
Say that Jaime
But
send you.
if you remind me that you were here at this event, then I will be more likely to get back to you.
Okay, well, thank you again, Ron, and I hope you enjoy your time in Peru. And before we leave, because we're going to have a networking afterwards, I do want to invite the BCP team. Quiero invitar al equipo de BCP Partnership para que nos pueda venir y dar unas pequeñas palabras de cierre. No sé si está Lorena por ahí o alguien más del equipo va a querer. Oscar, ¿estás por ahí? Bienvenido, pasa acá adelante. And for us now, Ron, thank you, and I hope to see you again soon.
Yeah, encantado. Appreciate it.